Fantastic. Okay, well, good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. It's Thursday, May the 18th. I'm delighted to be joined by Mr. Mehmet Ogucu, Group CEO of Global Resources Partnership and Chairman at the London Energy Club, Dr. Radl Kadiri, MD of Energy, Climate and Resources at the Eurasia Group, and Peter Maguire, CEO of XM Australia. So thanks a lot, gentlemen, for joining us this morning. Can we just have that survey question and poll up again, please, just to have a look at that again. We had that earlier this week, talking about demand, the demand picture. Global oil demand is set to expand this year to reach 102 million barrels a day, with recent Chinese mobility data showing its economy continuing to rebound. Will OPEC raise or continue with oil supply cuts in the second half? We had cuts winning that question, 62%. Rad, let me go to you first on that. Let's talk a bit about supply and demand. We do see oil prices still hovering sort of below $75, not sort of near the 80 that OPEC has said it's kind of its minimum, let's say, target, at least unofficially. Nothing that it's done so far seems to be keeping it at $80, right? Give us an idea of where the demand picture is today, whether we expect that to improve to lift prices back to 80 as OPEC wants, and if not, will it step in 2 weeks and cut more?
I mean, I think OPEC faces a very difficult decision in 2 weeks' time. If you look at the slightly longer term data and you look at the underlying demand data, particularly coming out of China, coming out of India and Asia more generally, I mean, this increase in mobility demand is significant. And I think if we go back to the start of the year and we look at what was anticipated to be driving demand growth this year, it was going to be on the mobility side. And I think there were sort of expectations also, or an understanding also, that we were starting from a lower baseline with demand destruction in China last year. But I think where the market is caught right now, and this is what creates the difficulties for OPEC, is that sentiment is slightly out of whack with the fundamentals. So while the fundamentals seem to be providing some support, and I think as you look forward into the second half, there's certainly cause to be optimistic about fundamentals. The market is focused on the potential downside, particularly of a US banking crisis sort of getting worse, and potentials for EU recession. Looking at some of the industrial data and industrial demand and manufacturing data, which has not been as strong. And I think sort of being somewhat confused by the recovery in China and an expectation somehow that China was going to go all pistons charging this year, when in fact the recovery it's been stuttering, and it's been far more on the consumption and consumer side than it has been on the industrial and infrastructure side. So what's balancing sort of some of those mobility numbers in terms of jet fuel, in terms of gasoline, is poorer demand on the diesel side. And as I say, some of the weak refining margins in Asia have also sort of helped to drag that down.
Okay, thanks, Rad. Peter, let me go to you on that. I mean, the market keeps saying, well, we're still a bit uncertain about where China demand is going to go in the second half, etc. Or we're still waiting to see if there's going to be a recession in the US or Europe. We're at the end of May nearly. We've had a few months now to kind of settle into 2023. Why is there still this sort of negative sentiment that's holding prices back when we see supply tightening, etc.? When are we going to see that sentiment turn, do you think?
Well, a couple of things, Diala, and welcome to everyone, and greetings from Sydney. I'll answer it in a couple of ways. First off, when I look, we're halfway through second quarter. We're 6 weeks out from the start of the third, and you would have thought there'd be more demand for crude and for energy, in which there will be, I think, over this Northern Hemisphere summer. You put the end of COVID, you start getting consumers driving motor cars are crisscrossing nations. Certainly in Europe and certainly in America, I think that's going to be a very strong demand picture. The second part is, if I look at iron ore production, and that's what Australia is exporting to China and their appetite, March was the largest month on record as far as departures and raw tonnage, I understand, from Port Hedland, northern Western Australia. So the demand picture to China is immense. I don't know where they're storing the stuff. I mean, they must have some big warehouses. So I think it's the old story. They're buying cheap. or cheaper. And they've done that very successfully and played that strategy for decades. And at low times, they buy up big, and at high times, they might pull back. So I don't necessarily believe the numbers. I think it's relatively strong in China. As far as global demand and how they export those finished goods out, well, that's a different story altogether, whether consumers are going to keep on buying washing machines and whatever else. So we've just got to work through that. And then from the consumption phase, rates are starting to hurt, I think. The debt ceiling situation is certainly raising its head. Main Street is saying that the three people to watch, Fed, Treasury, and certainly Biden, and see if they're prepared to massage a deal together with McCarthy, Republican, well, the Speaker in Congress. So I think we could see some fireworks in the next matter of weeks. And yeah, it's going to be exciting. US dollar strengthened a little bit. And I think it's a great time to be in the markets trading.
Okay, yeah, it certainly seems that things are beginning to sort of settle. And my gut feeling would be the second half, we're going to see things take off more in China, more evidently. Mehmet, welcome again. Great to have you. And before I ask you about anything energy related, we must talk about your point of view on the Turkish elections and what significance that's going to have, again, geopolitically on the region and on energy flows in the end of the day as well. We obviously all know now that it's gone forward to a second round. Were you surprised by the results that we saw? There were polls showing that, you know, we may have a change of guard in Turkey, and now it seems not.
Well, yes. I mean, the widespread feeling was that because of what happened in Turkish economy, politics, earthquake, and the inflation soaring, and earthquake disrupting the whole economy, bringing an additional $100 billion cost and whatever, and also you know, democracy, human rights, freedoms. Many people expected that after 21 years, Erdogan will be worn out, and the new opposition figure with support from 6+1 party, 7 parties almost. So this was Erdogan's days were counted. But what we saw on the first round of election is Erdogan got about 4% lead over his rival. And this was a surprise to many, both in Turkey and internationally. And whether there were some election irregularities, rigging or not, so this is still going on. But there wasn't a widespread feeling that, you know, this election was rigged. It was free, though it wasn't fair. And so now everybody thinks what might emerge at the end of the second tour. And unless there is a game-changing campaign by the opposition, all indications lead to the conclusion that Erdogan might still win the second round, although he's not so relaxed. He's working as if it's the new election for the second round. So it's going to have a serious implication, not only for Turkish economy. As I said, it's under huge stress now, and there is no access to fresh money, neither FDI nor portfolio investment coming to Turkey. And Turkey's coffers, treasury funds, as well as central bank reserves are in minus $70 billion almost. So either there's going to be a huge turnaround in Turkish economy in terms of orthodox policies as opposed to Erdogan's what he called unorthodox policies in terms of interest rate raise and currency appreciation, depreciation. There is a very, very serious risk of Turkish economy defaulting, because right now, I think the risk is almost 700. It has risen to 700, but it's 1,000. So that's officially default position. So we are expecting a very, very serious economic crisis in Turkey if Erdogan wins, if there is no change in mindset and policies and execution. So international markets are already buying the possibility that Erdogan might be the winner in the election. So geopolitically, of course, this will also have impact on the region that we are talking about.
Absolutely. Well, Rad, let me go to you with that. I mean, what impact will it have, let's say, on Turkey's relations, with Russia, with the Gulf, etc., with Europe? In terms of, let's make an assumption Erdogan stays, contrary to what people were thinking a week ago. How destructive is that to not only to Turkey per se, as Mehmet has just outlined, its economy, but will there be reverberations beyond that, and on the energy front, what impact that could have?
I'm not sure how much reverberation there'll be. I mean, as Mehmet said, this is business as usual. Erdogan comes back in, obviously sort of a balance of payments crisis, a financial crisis sort of will impact Turkey. It will, obviously sort of weaken Turkey's hand in terms of this. But I think what you've seen in terms of Turkish foreign policy has been a step back, sort of really even over the last 18 months. That sort of very interventionist policy, that confrontationist policy, that effort to try and, the engagement that you saw in Libya, the engagement that you saw elsewhere, competition with the UAE, with Saudi Arabia, all of that is eased. And I think, within the context of efforts in the region to try and manage their own security relationships and try and manage their own affairs. So, I think, Erdogan has also sort of made signals in terms of, willingness to look at Sweden's accession to NATO and various others. So I think, you'll get business as usual to a certain extent, and Erdogan somewhat chastened by experience, but showing the signs of being chastened even before the elections took place.
Okay, Peter, let's talk a bit about Russia. I know you're in the east there in Australia and Asia, but in terms of, we've got a headline on our bulletin today saying India took record, amounts of Russian crude in April. That's been pretty consistent in the first quarter, really. No end in sight there in terms of Russian flows being disrupted in any way. And we have even Putin calling for OPEC to stick to cuts, etc., support the price. Have we now settled into a very secure status quo for the remainder of the year on Russian oil flows? No impact in terms of its budget, the government budget being affected, and by its war effort. We're going to continue to see that sort of Russian production exports go without any disruption.
Yeah, I'll answer that certainly. I'd just like to move back to Turkey for one small second, if I can, and get everyone as far as a checkup from the neck up for our viewers. If we look at the Istanbul 100, in 2018, it was 1,000 points. It was still that in mid-2020. We are now at just under 5,000 points, and it's been an enormous uptick. So what we say about Erdogan, and I'm not here, I sit in Sydney, Australia, I don't have a view on it, but you would have to say that the enormous growth that they've seen in their stock market over the last couple of years has been nothing short of breathtaking. And I'll go into further analysis as far as currency after this question. But as far as Russia's situation, yes, it seems to be onward and upward. I don't see any sanctions or any issues affecting balance sheets. I'm pretty sure that they seem to be motoring along quite well. From an agricultural side, they're telling me that crops are relatively strong. They're telling me that the mining side of things with nickel production and their base metals, nothing's really hiccup there. And their energy, I was in Doha the other week, and I had a conversation with someone, and they said China's demand for Russian crude is strong. India, the teapot refineries in China are, very happy with their Russian crude. So I don't know. I scratch my head here from Sydney, Australia, saying, really, what is the storyline? And it seems to be, I think, more to the tune that their recovery costs, I think, would be fairly economical. And at these sort of dollar values, paying in, depending upon how they're being paid, there's talk that there was Bitcoin, there was talk that it was yuan or ruble, everything but petrodollar. So it seems to be, the storyline is the BRIC nations gaining momentum as far as being against the petrodollar. And that seems to have a very strong chorus of many participants at the moment.
Okay, Mehmet, let's talk a bit about gas and Europe. We've seen, the continent doing okay over the last winter. Stockpiles are pretty healthy at the moment. A lot of options of LNG are being offered Europe's way. Is there any feeling in Europe that there will be any sort of gas crisis in the next 6 to 12 months. Prices are pretty moderate right now and pretty comfortable. Could we see a repetition of last year anymore, given how Europe's got its act together?
Well, actually, Europe, as you said, has put its act together quite successfully, better than we all expected. We're discussing about the harsh winter biting the public as well as the economy in Europe. However, now, as you say, stocks are almost full and the LNG supplies are sufficient and diversification is going ahead. And I was surprised that Germany actually shut down 3 nuclear power plants a little bit by their, of course, timetable. However, many people hoped that it was going to continue for a while until things are really restored. And EU has successfully changed its energy supply architecture. And Russian oil and gas, as we know, now diverted to Asia to a great extent, and Turkey at a favorable discount rates. But we were having here in Sicily a meeting about Ukraine, how the crisis in Ukraine might be affecting European markets as well as the Mediterranean energy scene. And in this regard, now I think there is a new military counteroffensive expected from Ukraine. It's not going to happen soon, probably in summer. But Russians already started destroying some of the air defense system provided by the US, Patriot missile system. And then almost half of the Russian energy installation and infrastructure wiped out by the Russians, mostly coal-fired power plants, renewable plants, but they haven't touched the gas pipelines, unsurprising, of course. And this is going to have a huge impact on Turkey. And because there is also, as you know, Turkish Black Sea gas activity, Discovery turned already a production and gas processing plant has been created in a record time in Filios. And there's a discussion of whether other littoral nations except Russia, like Romania, Bulgaria, Georgia, Ukraine to a certain extent, although Ukraine lost a great deal of its maritime sovereignty to Russia, could come together and develop jointly perhaps their resources. And on the Mediterranean scene, there is some uneasiness, of course, because unlike so many people expected, including me, there is no room for East Med gas in European gas markets, right? Because it's going to take some time and Europe needs gas if it will come in the next 2 years maximum. Beyond that, any plans, Europe is not interested. And I also agree with the previous speaker that Turkey is easing its pressure in the region. Well, one reason is that it doesn't work as foreign policy adventures in the region. Second reason is that after the election, to avoid an economic collapse, there will be need for raising funds from the West and from the Gulf nations, especially. Turkey is cozying up with Riyadh and also Abu Dhabi, as we know. There is a recalibration of Turkish foreign policy in this regard. What will happen in Syria is also very important because first time Turkish and Syrian foreign ministers met in Moscow with help from their Russian friends. So there is an easing of situation relatively geopolitically in the region. This will have, of course, ramifications for the global and regional energy markets to a great extent.
Of course, yeah. I mean, well, easing of the geopolitical situation, I don't know. Certainly new partnerships and new relationships trying to be made. Rad, let's go to that. Talk about I wanted to ask your opinion on Turkey, Iraq, actually, in terms of Iraq production and exports and how Turkey and Iraq are sort of playing around the Kurdistan sort of supply chain, if you like, there. Do you see, we keep seeing delays there happening in terms of getting those exports out? What impact will that have in terms of Iraq's position within OPEC? And any impact on the sort of cuts that OPEC Plus has made from a volume point of view?
I think, you know, what it's done in the very short term is allowed Iraq to offer to make voluntary cuts and to say those voluntary cuts will last for the remainder of the year, and doing so in such a way as the total of those voluntary cuts may mirror what is being enforced on Iraq, which is the loss of about 400 to 450,000 barrels a day of exports through Turkey. You know, I think it does go back to a couple of things. One, I think Turkey, this is an opportunity for both Baghdad and Ankara to remind the KRG that it's the weak link in this arrangement. And I think, both sides have taken advantage of this, despite some sort of good rhetoric from Baghdad towards Erbil. It's nonetheless sort of allowed Baghdad to sort of reassert sovereignty, reassert control over the energy industry in Iraq at large. It's going to come at some cost. But I think from a Turkish perspective, this ultimately goes down to money as much as anything else. The resolution of the arbitration case nominally put sort of the burden and the cost of $1.5 billion onto Ankara. There is, that is the first of two arbitration cases, and the second one may well sort of deliver a similar ruling in terms of the legality of those exports that took place, and in this case, after 2018, which may come with a similar financial penalty. And quite frankly, I don't think Turkey's in any position to sort of be paying out several $1 billion to Baghdad or anywhere else right now, given some of its economic weakness. So I think that sort of ultimately what the Turks will do is play hardball on the exports. They control the valve at the end of the day. But it's in Baghdad's interest to sort of come to a deal on that. So we'll wait and see what happens with the elections in Turkey. It certainly was never going to be resolved before that. And then afterwards, we'll see in terms of, what other issues come up. But I think the Turks will also sort of require a certain amount of security guarantees from Baghdad in terms of the border between themselves and the KRG, and will want some guarantees out of Erbil as well that it will remain relatively pliant and quiescent into the future.
Okay, thanks, Ryan. Let's look at that survey. Sorry, just a moment. Yeah, just look at that survey question before we take it off. What is more likely to pull oil prices back up to $80? Stronger China demand in Q3, another OPEC plus cut announcement in a couple of weeks, or a clear signal from the US Fed that interest rates have plateaued. I wanted to go to Peter on the interest rate front as well, but let's have a look at that later to see what we get. Sorry, Mehmet, you wanted just to comment?
Yeah, I just wanted to say a couple of words about KRG.
Yeah.
Yes, I think this deal, the arbitration deal, put Turkey in a difficult position. Actually, we were expecting a much higher amount because Iraqis asked for $30 billion compensation, but 1.5. I don't think that Turkey will pay this, although Ankara said it's willing to consider paying, because there's an agreement between KRG and Ankara. In such cases, any penalty will be pushed back to KRG. KRG will have to pay this. And I think Turkey is also negotiating with Baghdad that the second case in Paris arbitration court might be perhaps withdrawn by Iraq. If they don't, Turkey is negotiating this in the bargaining table that the exports may not resume from KRG. This is going to put KRG in a difficult position because this is the only income source for KRG. And then there are also security guarantees that mentioned already, because PKK is very active in the KRG part of Iraq, and Turkey is very sensitive on that. So for economic and geopolitical reasons, Ankara will continue to negotiate how it will allow resumption of Iraqi and KRG oil back to Ceyhan. So it's not a done deal, but I think both sides are negotiating about it. And there are also good signals from Baghdad, because both Ankara and Baghdad agreed to create a sort of similar China Belt and Road initiative between Basra and Turkey. This has also significant strategic importance for both nations. So in between, I hope KRG will not be squeezed. So they have to find a solution that will be win-win for three parties.
Inshallah, as they say, and let's see what difference it would make if we have a new leadership in Turkey. Peter, back to you just on that question of what's going to take to kind of maybe bring prices back towards 80. We have three options there, but of course another option which could help is this US SPR refill plan. It was being dismissed a lot earlier this year because it wasn't coming to the fore. Would that lend support? Is it lending support to sentiment? And which of those other three factors would you say needs to be the strongest to really get us up there, if anything?
Well, yes, I think it's certainly going to support prices if Biden refills the tanks. So there's the first part of it, and we've just got to wait and see whether he does that. It's hard to comment on his administration. It's been a very interesting 2.5 years so far. And I think he's got a number of big hurdles ahead of him before he gets to the SPR. The second part is, you mentioned quickly, as far as rates and policy and where the Fed runs, markets are saying we're going to see starting from September. This is what the analysts and everyone's hanging their hat on. Whether that materializes, well, we're in May now, and that's 4 months away, so 3.5. So we've just got to ride that wild bronco all the way to September. There's a lot of things can happen between now and then, as far as policy, inflation story, more uncertainty with debt ceilings and whether that's managed or it's protracted. So this is where we sit at the moment. And I would say if the market is satisfied and all those ducks in a row fall and everything's okay, then we roll into a final quarter of the year in a not a bad position with rate cuts and, you know, return to some stronger sentiment and growth. But I think there's a lot of water to pass under the bridge between now and then, Diala.
Okay, thanks, Rad. I mean, on that front of rate cuts, expectations, certainly things feel like they've calmed down a bit, i.e. being priced in more or less more accurately. But where is the sentiment today as we start almost the second half of the year in the US economy? Still going pretty strong, isn't it? Jobs data's okay, has disintegrated a bit, but it's still strong. No sign of, you know, real recession coming anymore. Would you agree with that, or are we still going to expect that to happen sometime this year?
I think that's the interesting thing about markets and sentiment at this moment in time, is that if you look at the sort of economic data and you look at the economic numbers, I mean, you've got mixed data sort of around the world, and China included. But, you know, Peter's comment earlier was spot on. It is that, you know, the underlying sort of data does point to strengths in fundamentals. Yet sentiment seems to be sort of doggedly bearish, and, you know, a market that is over-indexing to focusing on sort of bad news as opposed to good news when it comes to oil markets, and certainly when it comes to demand. And, you know, I think it's going to take some sort of big numbers out of China to shake some of that torpor and to shake some of that underlying depression. But, you know, this certainly seems to be a market that is far more willing to believe that things will get worse as opposed to things will get better, or at least sort of unwilling to see a tightening in the second half. And you know, that sense that, you know, you're going to see price weakness in the absence of either a move by OPEC or somebody else, but something else. But so I do think the second half is going to sort of start to deliver some numbers as we move into it quite quickly. It'll be interesting over the next sort of 2 months as you start to get year-on-year numbers out of China, just based on where they were 12 months ago. And I think it was the IEA that sort of said in their April reports that, you know, even if Chinese demand stays where it is right now and doesn't grow significantly, that still sort of is likely to amount to almost 1 million barrels a day of additional demand this year compared to last year. But, you know, the market is ignoring that. I think there's a certain amount of technical trading that's sort of driving prices down, that's betting against prices. Certainly the shorts seem to be sort of coming on strong. So, you know, it will take something very significant to shift the sentiments. But as Peter mentioned, sort of once that sentiment does shift, I think you could see quite a strong upward correction.
Well, I mean, as you said, and certainly OPEC's forecast and the IEA are more positive about demand than some other agencies. But Raj, just to stick with you, how quickly do you think OPEC would move the other way to sort of add production back if we do start to see that extra million coming in from China overnight, you know, possibly? Will it be reacting, do you think, as promptly and as in advance as it has done with the cuts?
Look, I think OPEC has always been proactive on the downside and reactive on the upside of prices. So, you know, OPEC's willingness to react quickly when prices are rising and there's a correction, you know, is probably going to be more stunted. So I don't anticipate that OPEC would step in with additional supply quickly. You know, you could see some movement on the margins, but I think, you know, OPEC will want to see signs of not only sustained fundamentals, but a sustained change in market sentiment before it does anything to sort of potentially undermine a recovery of prices. I mean, as you mentioned, you know, $80 a barrel for Brent seems to be the floor. You know, I would say that 90 to 100 is the Goldilocks zone. So, you know, OPEC is going to be quite happy to allow prices to rise to that level before it takes any measures. And looking at the balance of things this year, it's tough to see three figures right now. So, you know, it may just sit tight, wait till December, and have the big sort of meeting in December to decide on new baselines and some of the political sort of problems that sort of are going to get in the way of you know, apportioning quotas in the future.
Okay, Peter, just one.
Could I also say something here?
Very quickly, yeah, we've run out of time.
Yes, because I mean, what we see is that IOCs are making record profits. We see that about $5 billion from Shell, BP, ExxonMobil, and Chevron. And there is also a risk that this money is not spent on the new oil investment, new exploration and production. And IEA warned several times that we might be expecting some supply crunch down the road. And even if OPEC Plus wants to increase the production at some point, perhaps after December, as we discussed, and there will be serious difficulty of supply situation. We are focusing so much on the demand side, but we shouldn't ignore the fact that underinvestment will be causing some sort of crunch in the markets, medium to long term.
Absolutely.
Absolutely.
Next year. Peter, very quickly, US dollar index. I don't know if you mentioned the dollar, but I mean, do you see that sort of, I suppose, weakening in the next 6 months or not on the whole?
Okay, it's had a nice rally to the upside in the last probably week and a bit. We're nearly at 103. We're at, you know, that 101.50. There was everyone saying, are we going to see sub 100? At the moment, there seems to be an uptick as far as US dollar. Now, that could be building on the debt ceiling being sorted. There's and we've got to live through that. And if that is sorted and all the cards are dealt and everyone's happy, and you know, this time next month it's done and dusted. But if it's not, then I think there's going to be a significant sell-off as far as US dollar. People will lose a faith in it in some ways, and so I wouldn't be surprised for it to be spanked down aggressively. So that's my point. And then the other side is building on what Rad and Mehmet said as far as oil. And if they, I know that they, you know, the $90 to $100 handle is where OPEC want price. I don't think they necessarily want 80. And if there is any chance that it gets to those sort of numbers, if it doesn't, I think you're going to see cuts to try and get, you know, get a fair value. And they're conscious that US dollars come under big sell-off from 114 to 102 since October last year. So you don't have to be a mathematician to work out the differential.
Thanks very much, Peter. Okay, gentlemen, thank you so much. We run out of time. Thanks, Mehmet and Rad, as well, for joining us.
My pleasure.
Thank you.
Thank you. Thank you, Rad. Mehmet. Cheers, Diala.
Bye-bye.
Bye.